Good morning. My name is Nikila Siani, and my team and I are here today representing Glenfield College, and this is our June monetary policy statement. While CPI inflation is currently within the 1 to 3% PTA target at 1.5%, demand pressures in the New Zealand economy indicate that inflation will increase in the medium term. In order to keep future inflation contained, it is our belief that the OCR should increase to 3.25%. An increase in the OCR affects the level of AD with a 12 to 18 month lag. Therefore, an increase is needed now to keep future inflation building in the economy contained. The positive output gap shown on the graph indicates that actual GDP has now been growing faster than potential GDP, as spare capacity in the economy, initially from the 2007-8 recession, has now been absorbed. With the economy running above potential GDP, this results in resources, especially in the construction sector, being overutilized, and the factors increasing AD will have a more pronounced effect on inflation. After the 2007-8 recession, our economy lost all signs of growth. In order to exit the recessionary period and move to one of recovery, we needed these extended period of low interest rates to boost demand. However, with inflation and growth now showing signs of increasing, we no longer require these same low rates to boost demand, and instead, our OCR must be raised and heading towards a neutral level that will ensure our economy runs as close as possible to potential GDP. Our decision today has been made by assessing various economic data within New Zealand and abroad. Salman will cover the factors creating domestic upward inflationary pressures. James will then cover the factors creating downward inflationary pressures, as well as then discussing the global influence on inflation in our economy. I will then return to conclude our statement. I'll now pass it over to Salman. Thank you.
Employment levels in New Zealand are currently at historical highs, as can be seen on the graph by the blue line. With GDP rising, the economy is expanding rapidly, therefore creating new jobs. Increases in net immigration and the Canterbury rebuild are expected to be particularly strong drivers of employment growth. The strong employment levels seen are putting upward pressures on AD, increasing inflationary pressures through increasing both disposable incomes of households and investments by businesses. Consumer confidence and spending levels in New Zealand are high, as can be seen on the first graph. This is due to high levels of employment, strong population growth, cheaper imports, high house prices influencing the wealth effect, low interest rates making credit cheap and creating high household debt, as can be seen on the second graph. With consumers feeling confident about their financial position, coupled with an increased disposable income, consumer spending is high, putting upward pressures on AD and increasing inflationary pressures. With the economy gaining momentum, many firms are gaining confidence. Therefore, real business confidence and investment levels are at a high, as can be seen on the graph. The high exchange rate, strong profit expectations, high levels of consumer spending, and low prices for imported resources have all helped increase investment spending and business confidence and point to strong GDP growth in the future. High business confidence is putting upward pressure on AD, increasing inflationary pressures through increased investment spending. Nationwide construction has been increasing as a result of the earthquake rebuild and stronger housing demand due to a shortage of supply. This is causing strong construction cost inflation, especially in Canterbury and Auckland, as there are high capacity pressures in the industry due to limited resources. There's also the risk of this cost inflation flowing to other sectors and regions, particularly in housing affordability. The increases in construction activity are a key component keeping non-tradables inflation high. The recent house price inflation reflects a strong demand and supply imbalance. High demand for housing can be explained by strong net immigration, increased foreign demand, and lower interest rates. Reducing the supply are housing shortages in Auckland and Canterbury. This is resulting in the high house price inflation, as can be seen on the graph. The house price inflation is keeping non-tradables inflation high. Therefore, higher interest rates are needed to reduce the demand and inflationary pressures in the housing market. However, recently we have seen some moderation in the housing market through the effect of a macroprudential tool implemented by the RBNZ known as LVRs. With the removal expected in the future, interest rates will need to be increased to reduce the inflationary pressure in the housing market. A trade surplus of $534 million in April was reported. This surplus has been influenced by strong demand and prices for our major commodities, as can be seen on the graph, to our main trading partners, specifically Australia and China. Strong demand from our trading partners and high commodity prices have increased exports, therefore putting upward pressure on AD and increasing inflationary pressures. I will now hand it over to James.
One factor that is offsetting inflationary pressures is the recent fall in dairy prices, totaling to well over 27%. This is being caused by a strong increase in global production in response to high prices and a temporary drop in Chinese demand. With dairy making up 30% of our exports, and with Fonterra expected to reduce their payouts, the decrease in income will have an effect on not only our terms of trade, but our whole economy. However, dairy prices and industry growth are still at historically high levels, which is all expected to continue due to increasing demand from China. Also, offsetting the decrease in dairy prices has been increasing major commodities such as New Zealand lamb and fruit. Strong commodity prices, growth speculations, increases in net immigration, and the increased earning potential of investors attracted by New Zealand's relatively higher interest rates are all keeping the New Zealand dollar at elevated levels. The high New Zealand dollar is reducing the price of overseas imports, but also decreasing the competitiveness and incomes of exporters, especially for our non-commodity exporters, and therefore has an overall negative effect on our economy, reducing inflation in the tradable sector. The latest budget highlights the government's short-term target of achieving a budget surplus and its long-term target of fiscal consolidation, in other words, getting debt back down to about 20% of GDP by 2020. This projected budget surplus will put slight downward pressures on AD, as it acts as a small net withdrawal from the circular flow by reducing government spending. The higher rates of labor participation, as can be seen on the graph, are providing a strong supply of workers to meet demand. This helps to minimize wage inflation and could mean lower cost of production, easing cost-push inflation in the short term. We expect this to continue as strong migration inflows carry on over 2014. In the long term, the increase in labor supply may also raise our economy's productive capacity, resulting in sustained economic growth. Therefore, net immigration has the potential to not only affect AD and AS, but also the long-run aggregate supply curve. At the moment, we do not see a threat of a wage spiral, but with inflation rising, it is something we will continue to monitor. Increase in net immigration caused by a relatively strong employment outlook and fewer New Zealand citizens leaving to Australia are substantially increasing AD. This is because these additional people demand additional resources, all of which surpass the available supply, as can be seen in the housing market. Additional workers will help keep cost-push inflation contained. However, in the short term, will contribute more to AD, therefore increasing demand pull inflation. Due to New Zealand being an interdependent economy, changes in global markets will have a significant impact on our economy. Rising demand for exports from our major trading partners will result in continued demand for our exports. With China being a major trading partner, it is important to monitor the Chinese economy. For example, due to the decrease in construction activity in China, signs of falling forestry exports are starting to emerge in New Zealand. As New Zealand banks are net borrowers from overseas markets, foreign financial markets will affect our interest rates. With many economies having low OCRs, between 0 to 1%, international interest rates remain low, which will flow into lower funding costs for our local banks. I will now hand it to Nikila to conclude our statement.
To conclude, inflationary pressures are coming from increases in consumption and investment caused by rising net immigration and strong confidence and employment levels, as well as house price inflation and a trade surplus boosting net exports. Decreasing inflationary pressures are falling dairy prices and the high New Zealand dollar, lowering net exports, low wage-driven inflation, keeping cost-push inflation contained, and the surplus budget. At this point, we believe that a modest increase in the OCR is necessary to keep future inflation contained, as the upward pressures on aggregate demand are currently outweighing the downward pressures. In an economy where AD is creating strong demand pressure, interest rates must be raised in order to control these upward pressures and to ensure inflation remains close to the 2% target in the medium term, as stated by the PTA. However, in order to keep future inflation contained, we predict further rises in the OCR. However, in assessing the timing of these rises, there are a few factors that we think we need to monitor: the appreciation of the New Zealand dollar, the fall in dairy prices and incomes, the threat of a housing market crash, and how households and firms respond to interest rate rises after the extended period of low rates. On behalf of my team, thank you for your time. You're now welcome to ask any questions.
Thank you. So I'll start off with the first question. So in your presentation, you talked a bit about where you think interest rates are going to go in the future. Why do you think the Reserve Bank provides an indication to the public of where interest rates are going?
So I think firstly we want businesses to have certainty of
So they
Yeah.
can make informed economic
Yeah.
decisions.
So
And-
if there's no if they don't know, it could lead to uncertainty, which
Yeah.
reduces long-term planning and
Yeah.
Exactly.
investment.
Yeah. So when we have certainty in the economy, firms are more willing to make long-term investments instead of, for say, just trying to survive on a day-to-day basis. So again, increasing investments, increasing long-term sustained growth. So why it's important to monitor. Also, so by publishing these projections, it's going to allow businesses to make better decisions.
And they can monitor the same factors that the RBNZ are monitoring.
Yeah, all in all. Yeah, and again, with investments increasing, we should see flow-on effects to employment as well.
Yeah.
Employment.
And it's much better than relying on, say, on economists that aren't employed by the government. When you have someone trusted and employed by the government, their analysis is much more reliable and
Yeah.
valid.
So who'd like to sum that?
Okay, so we believe that in the long term, if investment, if the government publishes an OCR,
So the question was
Question
why
is
publish
why-
what we believe will affect the OCR?
Why we provide an indication of where interest rates are going in the future?
Why we want the economy to know where interest rates are going. Again, it relates to confidence levels.
also
Again.
investment.
Yeah.
we would
so
we would
sorry.
like businesses and investors to be confident, so that they know that they have this indicator which tells them how they should plan, how should they plan their long-term investments, and just to provide confidence in the economy.
Because when they have certainty, they're more likely to make those long-term investments, which will again create more economic growth. Then, say when there is uncertainty, firms will more. They're just trying to survive and stay afloat, so we'll see more short-term, day-to-day basis decisions.
Great, thank you.
Okay, can you tell me the role of inflation expectations in inflation outcomes?
Sorry.
What is the role of inflation expectations in inflation outcomes?
Is this the PTA target, right?
The role of
The role,
role
of
of inflation.
Expectations.
expectations.
What people think about inflation, how does that influence what will happen?
Oh,
Okay.
so inflationary expectations.
Expectations. Okay.
So I guess two things. Do deflationary as well? Just inflation?
If
I guess we
people-
should do both.
Yeah, do.
Yeah.
I think we can outweigh.
We can outweigh.
Yeah.
So do you want to talk about deflation maybe? What
Defl-
happens in deflation?
Deflation. So consumer spending will decrease because consumers will have incentive
They
to
will put off spending because prices are continuously dropping.
Yeah,
Yeah.
so,
Dropping.
yeah, so in order to maintain their purchasing power, they will delay purchases.
And
And,
this affects firms as well because they notice
there will
that
be a rising
because
unsold.
stocks of unsold
Yeah,
goods
It's
are
increasing, so
rising.
their profit will be less. So
Yeah,
they would have
will
to cut back
production,
production,
and
then
this affects employment
Employment,
as well
so,
because
yeah.
they have to cut back
as well.
production.
Again, so
So
lower
that will
in
reduce
confidence levels.
that will
Confidence,
reduce
yeah.
aggregate demand and
Yeah.
economic activity.
So when we're seeing, sorry?
And if consumers expect inflation to increase, they'll buy now in hopes of beating future price rises, which will increase demand in the economy and production and employment as a result.
Yeah, also, so when and then again, on the other side, inflationary pressures, we're going to see that affect businesses, again, through investments. They're less likely to invest, again, also flow-on effects through wages will also be pushed
Yeah.
up because
Yeah.
they'll want to maintain their
Because
purchasing power.
Yeah,
power.
the money, their wage will be devalued.
I mean,
Yeah.
both
Yeah.
There
cases
will be
we're
a
seeing
decrease of,
decreases in confidence
Yeah.
levels.
Levels.
Both of the cases, yeah. So, and again, both consumers and businesses are
Which can
confidence
change
levels.
Yeah.
inflation without an OCR change.
Yeah.
So,
Would you like to sum that up?
okay. So inflationary expectations can change demand and therefore inflation in economy without the RBNZ having to change the OCR. So if people think that inflation is increasing, they will spend now. And if they think it's deflation is occurring, they will put off their spending.
Good, thank you. Given the importance of those expectations, how do you think the Reserve Bank should go about managing them?
Well, the Reserve Bank currently issues a monthly statement.
And it's yeah. I think that the OCR we see OCR decisions 8 times a year, and
Yeah.
then 4 MPS statements a year. So again, providing the information in those statements will again create certainty for businesses and consumers. Sorry.
Yes.
Oh, okay. So the importance of providing.
How do they manage inflationary expectations?
Oh, so the way they manage inflationary expectations is through, firstly, the Reserve Bank they adjust the OCR 8 times a year, and with these they accompany a little statement, and that I guess addresses to the public where inflation is going, and then again you see the more detailed ones in, I think 4 times a year, the monetary policy statements, again addressing to the public where inflation is going, allowing them to make better decisions.
Okay, excellent, thank you.
So, how could the Christchurch rebuild affect the New Zealand economy and in particular domestic inflationary pressures? So if you could answer this question applying both economic theory as well as knowledge of what's happening in Christchurch at the moment.
Can you please repeat the question?
So how is the Canterbury rebuild affecting the New Zealand economy and in particular inflation in New Zealand? So apply economic theory as well as real world events.
Okay, so firstly, Christchurch rebuild, obviously construction firms increase in worker, they demand more labor as well. So again, I know a lot of the increases in net immigration are going towards Canterbury because they require the labor to help with the construction.
It also increases labor force participation within the set amount
so
of workers
within
currently
that,
working.
within that region, we should see more subdued wage inflation pressures.
Also increased demand for building resources, which may create inflation in that market.
Yeah, also
Yes.
again, there's a threat that these inflationary pressures could flow into
Yeah.
related industries as well as different regions as well. So we could see the construction cost inflation spreading again as well.
Which will increase inflation in the New Zealand economy.
Yeah, so, and then also generally construction rebuild, more essentially they're, by building more buildings, they're increasing production again, increasing AD through
And-
that.
And it increases employment as well because
Yeah.
And we would have a sustained economic growth.
Yeah, again, yeah.
The Christchurch rebuild itself is leading to an inflow of immigrants who affect our long run aggregate supply curve, because now there's a higher quantity of labor, which is a factor in production. So in turn, our long run aggregate supply line would move outward.
However, that would be a long-term
Long-term.
consequence. It's not,
Yes.
yeah. I
It
guess.
takes time to kick
yeah,
in.
exactly. We'd like to sum that up. Is that everything?
Yep.
Yeah.
Should I sum that up?
Yes. Go
Okay,
ahead.
so how the Christchurch rebuild would affect the economy and inflation. So firstly, the Christchurch rebuild, okay, so with the Christchurch rebuild, it's an increase
Okay.
in. Did you want to do that?
Yeah. So we've got an increase in net immigration, which itself leads to an increase in the supply of labor. So we've got factors reducing wage-driven inflation. So our costs of production are slightly going down in the short term, and in the long term, the increased supply of labor is after all increasing our economic capacity in the long run, and in the short term, it's increasing aggregate demand because additional
output through building, through the production of new buildings and then flow-on effects through employment as well. It's going to increase AD in the short term, so that's why it will create inflation.
Because right now the effects of AD are outweighing the effects of AS.
So, generally, when we see commodity prices fall, we see the exchange rate fall. But to date, commodity prices have fallen, but the exchange rate has not fallen to the same extent. Why do you think the exchange rate has not fallen?
Well, I think firstly there are other things that
Yeah.
affect the exchange rate aside
Yeah.
from
From
commodity
commodity
prices.
prices.
Like
So
demand.
we should probably list a few. So
Okay.
our relatively high interest rates.
Yep, which attracts foreign investors,
Investor.
which appreciates
On
the
the
New
New
Zealand
Zealand dollar.
Also,
We have other exports
Yeah,
such
other-
as
Yes, such as
lamb,
meat, wool,
fruit.
And although-
forestry as well.
Prices have fallen, they're still at historic highs.
so there is
Yeah.
still demand for
Yep.
dairy. And then
and as
again,
well as the increase in net immigration,
yeah,
which also increases.
more people coming here, they
appreciates
need
the
our
New Zealand
dollars. Yeah.
Because once they come over here, they have to exchange much of the money that they had back home into New Zealand dollars.
Yeah.
We've also got New Zealand is actually one of three economies in the entirety of the OECD that doesn't have a capital gains tax. So we've got it's one of the contributing factors to our to the housing bubble that's developing. We've got lots of speculation in capital assets because less has to go to tax, obviously.
So should I sum that up?
Yeah.
Yep, you can
So,
sum that up.
given the fall in, did you specifically ask about dairy? Was it? Or just
No,
commodities?
just
So, given
commodities.
the fall in commodity prices, we would assume that the New Zealand dollar should depreciate because a fall in these commodities would decrease the demand. However, should appreciate. Yeah, but it is depreciating. So the reason why is because we believe there are other factors that affect the New Zealand dollar aside from commodity prices, and these include our relatively higher interest rates. And because of this, we're going to see more people want to invest in our economy, raising the demand for the New Zealand dollar, as well as growth speculations. If people think our economy is growing, they want to invest here. You know, it's a place for money. It's a place for money to be as well. So increases in growth speculations. Also, for example, with dairy falling, even though it is falling, there is still a lot of demand for dairy. So there is still demand.
It's
Yeah.
at historically high levels.
Yeah.
Yeah.
And the increase in net immigration.
And then lastly, the increase in net immigration. With people coming here, they need our dollar to purchase things. So that again is increasing the demand. So overall, we believe these factors are outweighing the drop in demand due to the decrease in commodities.
Given everything that's going on with the exchange rate, do you think the Reserve Bank should intervene in the foreign exchange market?
Okay.
Well,
Well,
it could
there are, I guess, there are a few ways the Reserve Bank could intervene. Firstly,
an
through the
OCR.
OCR, and that would be an OCR decrease. But then
No,
again-
sorry. So forget traditional monetary policy. I'm strictly talking about the purchase or sale of foreign currency reserves.
So if we weren't looking at the OCR, so we've got either through a fixed currency or simply selling New Zealand dollars. And the way the Reserve Bank would do this, for example, should we use the US dollar as a guide?
Yeah.
So if the Reserve Bank were to buy US dollars, they're increasing the supply of the New Zealand dollar and decreasing the supply of the US dollar, which will cause our exchange rate to depreciate against the US dollar. Correct?
It also leads to the US dollar being appreciating.
Yeah,
and
because exchange rates come in
exchange
pairs.
rates come
If
in pairs.
our exchange rate depreciates, their exchange rate will appreciate.
Appreciate.
Again, this is going to create. So this is an option to cause the dollar to depreciate by increasing the supply into the market. But I don't think we should be doing this because firstly it would require large foreign reserves to constantly buy and sell the dollars to keep it at that lower level.
And it's not a good idea to deplete them
Yeah.
currently.
And then again
So
also
just-
sorry?
So just let it flow.
Yeah,
But
also
Naturally.
it's going to
Let
create
it
problems in the sense, obviously each economy prefers more exports
exports.
to less exports, and the way America could view it is that we're artificially intervening in the market to boost our exports, and then you could see them trying to
Trying to-
implement similar strategies as well through maybe trade barriers or doing the exact same thing. So it's not going to be
It's-
viewed favorably if we do artificially intervene in the market.
It's not great for relations.
Yeah. So I think, overall, I don't think we should intervene in the market
Yeah.
No.
because it is starting to depreciate naturally. I know over the last few months it has been starting to drop. We should just let it naturally
Fix itself.
depreciate. Yeah, let the market sort itself out.
Okay, thank you. Since 1973, New Zealand has not saved enough for its own investment purposes. Can you tell me the implications on the New Zealand economy, activity, inflation, productivity?
So, the effect of low savings on our economy.
Yes.
So firstly, the way I think I'd interpret this is if we have low savings, it's going to
Then
affect banks' funding costs.
Yeah.
So
Instability in the finance sector.
yeah, so with less savings there, it's harder. It's going to affect their funding costs. So they'll go up, and then again, it could. Again, this would decrease things like investments and
yeah.
things like capital. Again,
It's not
affecting long-term economic growth because things like investment and capital are the kind of things that would ensure long-term economic growth.
Yeah, it's not very great for our. If we had saved more in the past, we would have had a better credit rating by
Yeah.
now.
So, with savings being lower, can we assume that the OCR is high?
You tell me.
Well, yeah. I mean, we're seeing a decrease in savings. So the effect of that would that be a
Well, a
OCR?
decrease in savings
Would-
also indicates that
Would
there's
the OCR be low or high?
great
Yeah.
spending.
Because of
Right.
the low
Create
OCR.
lots of
because
Oh yeah,
of
OCR would
lower
be low.
return
Yeah,
on
yeah,
savings.
yeah. So, sorry, I didn't.
Low saving level means that it indicates that there's great spending levels.
Yeah, so
Yeah.
if we assume that there's a low OCR, again, this is going to affect things like, credit's going to become cheaper, so it's going to create more high household debt levels,
Yeah.
and
And loans more expensive.
yeah. So it's not good for our economy.
Yeah.
I'd like to sum that up.
So since we had less saving in the past, this meant that our funding costs have been relatively high for our banks
Because the banks have less money.
have less money. There's less money. Savings go into the financial sector. Less savings mean banks have less money to lend out. This also suggests that our banks wouldn't have invested as much money as they can into capital and other assets that banks invest in, and
again,
capital
potentially limiting long-term economic growth.
economic growth investment.
Yeah, it's also if we're assuming because savings are low, we would see a low OCR. Again, credit's going to become cheaper. So with credit being cheaper, again, it's going to contribute to our already high household debt levels.
Okay, good.
So it's bad for our economy.
Okay, very good. Changing topics a little bit, why do you think it's a good idea that the Reserve Bank gets to decide on monetary policy and not the Minister of Finance?
So as opposed to the government.
Well, the government does have a say. In 2000, the policy targets agreement
They
was
make the PTA.
Yeah.
It's
In
an economy.
agreement with the
agreement.
Reserve Bank.
So they get a
They
say to define what
What
we define as price stability.
stability.
But then again, it would be
They
the
can
reserve.
implement it.
Yeah, it's a Reserve RBNZ's job to implement it.
And this means that the OCR decisions are separate from political campaigns and all that.
Yeah, because
Yeah.
They would
Unbiased
have to
decisions
lo-
are made.
Yeah.
for example, if we use now for an example with elections coming up,
They have to lower the
yeah,
Yeah.
politicians would want
Yeah.
to keep OCRs low to keep consumers happy.
so
Yeah.
that they don't have to pay much on their mortgage
and
and
However,
price.
this
House
would be
prices.
disastrous for the economy because it just lead to inflation. So that's why it's important that the RBNZ can look at the economy objectively and make the right
Unbiased
decisions.
Unbiased.
Yeah, unbiased decisions.
free from political
Yeah.
interference,
Who would-
because if Reserve Bank governors have to rely on like campaign donations, you know what
Yeah, it
happens.
gets complicated.
He who pays the musician gets to decide the tune.
Right, very good, yes. So just one more minute. If I asked you to construct a measure of the real exchange rate, how would you do that?
How would we determine what the exchange rate should be?
Sorry. Did I say the wrong thing? I meant interest rates, real interest rates. So can you construct a measure of the real interest rate?
A measure.
Can we
Something about
construct
Christ.
a measure for the real
Real interest
as
rate.
opposed to
As opposed to like nominal interest
Is
rates.
it?
Yeah.
Is it
Ah.
adjusted
Inflation.
is that
for
how
the effects?
so okay, so we've got that nominal versus real to start.
How would we get the real interest rate?
So we take away the
Effects
of
of
inflation.
inflation.
How would we do that? Some form of calculation. To how do you get rid of a base index system?
Don't overcomplicate the question. If you go down to Lambton Key, you'll see an interest rate advertised on the window of any bank. Is that any use to me in terms of its performance on the economy? Not really. I need a measure of the real interest rate. So how do I calculate it?
Interest rates. You just got to take a look at the OCR. It's basically the one that all banks had to.
The bank to the banks, the Reserve Bank.
Yeah, it's the bank to the banks, and it's the base that the other banks have to go and take, and like pay interest on, basically.
Can I slightly redirect you? What's the difference between a nominal interest rate and a real interest rate?
So a nominal interest rate is with the effects of inflation,
Inflation.
whereas a real interest rate takes away the
Adjusted.
it's adjusted
Adjusted
for
for
the effects of
inflation.
inflation.
That was the answer. Okay, and I apologize, I said the wrong thing initially. I said the real exchange rate. But okay, so how would you do? So follow-up question. So how would I do that?
Again,
So
same,
real
same
exchange
answer.
rate
Is
would take away the effects of
Of
inflation.
Just taking the CPI into account.
Yeah. Whereas a nominal
Perhaps.
Really? Just in New Zealand?
oh.
So what is the exchange rate?
Okay, interest rate or exchange rate?
Exchange
So we're
rate.
talking about exchange rates now,
Okay.
Yeah.
and I want a measure of the real exchange rate.
So would we take would we have to take into account both parties? So
you mean
oh man.
We would probably be taking into account how say if we had inflation in our economy it
Versus
would reduce
inflation. Yeah.
how it would basically lead our base price higher, so our
'Cause
exchange.
Because an exchange rate is between two economies, so
Yeah.
Yeah.
would we have to take away we'd have to use the real interest rate of both economies?
yeah?
Okay, we're out of time, so you need to summarize where you've got to.
All right, anyone would like to sum that up?
Okay, Hila.
Okay, I'll go for it. Basically, we need before we get to know our real exchange rate, we have to first take into account and see if there's any temporary inflation that we have in our economy, and see, because it increases like the base, like the sort of the baseline of prices for our commodities, whereas like in different times that without the inflation we might have a different start to our commodity prices that could affect our exchange rates and the products that we sell to foreign markets.
Okay, I think we are out of time though. We'll stop there. You can relax, take a deep breath, you can enjoy the rest of the day.